as well joins in on the show right now. Mayuresh, hi, afternoon. What was your takeaway from Nestle, ITC, and Unilever's performance?
Afternoon, Aisha. Obviously, I think the volume growth that was anticipated by the markets, volume growth definitely has come a tad lower, both for HUL and Nestle as well. 2% for HUL, Nestle also 4 and 4.5%, a tad lower than what the street was probably believing in. But it was largely a combination of two factors, Aisha. One, the commentary surrounding rural discretionary spending expected to come back in a very moderate fashion. A large part of the analysts were believing in a very strong rural recovery in the second half, which obviously gives a huge impetus to FMCG players, both in terms of their volume and value growth. And if it's a moderate recovery, the expectations in terms of significant volume growth gets pushed back probably to the first half of the next financial year. Having said that, the kind of ad spend and the increases in ad spends by HUL, almost 11 odd percent, they will have to ramp up their ad spends. A lot of these FMCG companies, if they need to push their products through and their SKUs across price points in different markets and in different geographies as well, to probably ensure that volume stroke value growth happens at a reasonable pace. Having said that, valuations are again not too cheap for the space and within the space for HUL and Nestle. And therefore, I think the stocks might just go into a deep time and price wise correction both. As we see it. ITC, reasonable set of numbers as far as most of their business segments are concerned. Again, the underlying issue in terms of how cigarette volume growth will be in the next few quarters is going to be a very key facet to be watched out for. Paperboards should bounce back in the second half in terms of expectations of demand coming back strongly and expectations of price increases taking margins and protecting them as well. Hotel business, agri-business expected to do well in the second half as well. So ITC, relatively better placed, both from a number and a structural perspective as far as the next few quarters are concerned within the FMCG space.
Okay, commentary coming in from Laurus Labs right now. They're saying that the continued focus on growth capex is going to continue in the CDMO division. By the way, the stock is lifted up over 3% from the session lows. FY24 is going to be a year of consolidation. That's the outlook that's they've projected. The stock already is now spiking up more than 400 rupees. Core growth rebounding and healthy demand environment in both the API as well as the FDF business. That's the commentary coming in from Laurus Labs. But just getting back to the FMCG names, Naresh, do you also believe there could be some more pressure for the likes of Unilever, ITC, and for that matter, even a Nestle? And if so be the case, is this dip to be bought into just yet?
So one has to be selective here in terms of the stock selection. So HUL has been sideways for the longest time. ITC was a huge outperformer in this last 2 years. But names like Nestle India has broken out into new all-time highs, looks promising. A Tata Consumer, which has clearly shown leadership, that looks interesting in the FMCG pack. Then you have Britannia, which has gone through a sideways consolidation, which could take a jump up. Same is the case with the Colgate, which is making new 52-week highs. So it seems like the leadership has changed from HUL ITC to the other names. So the view is to look out for dips in a Nestle, a Britannia, a Tata Consumer, rather than a dip in HUL to buy.
Lotus. That's what everybody's saying. 406 rupees for Lotus. These are con call highlights. H2 priorities include higher capacity utilization across network to support growth acceleration. Markets are liking whatever I think they're indicating. And that spike, it was like a big spike in the last 10-15 minutes of trade, is reminiscent of what the numbers are. Mayuresh, do you track Lotus?
Yes, I do.
Mayuresh, there are very few things you don't track. I've realized over the years. How do you keep up, man?
I think God's grace and hopefully I think interacting with all of you keeps me on my toes.
So you read over the weekend also?
Yes, I
Come
do.
on, yaar. What cricket match? Do something else over the weekend. I had this habit of reading numbers over the weekend. I said, I'm not doing it now. Okay, Lotus now.
No, so as far as Loris is concerned, I think two things happening here. If you go in terms of what the management commentary was a few quarters back, obviously the kind of pressures that they've seen both product-wise in their formulation synthesis business and the biologics business as well. that has meaningfully now got played out. They were expecting a second half recovery to probably come through. And therefore, sequentially, the numbers are a tad bit better as the street was expecting. I think two, three things here, Nikunj. One, I think in expectations of their custom synthesis business, the CS business, as we know, and the expectations in terms of the NCE drug substances. They are having dedicated resources towards that, as I've been reading through their transcripts. So this is one element that can continue doing well and expected to do well in the next few years. There is expectation of gradual traction in their formulations business. And with the total reactor capacity for the API plant expected to go up, both the APIs and biologics can be additional support units as far as earnings are concerned. So I think Laurus is very interestingly placed within the pharma universe. We probably remain optimistic. A little bit of price strength is what will make us even more sanguine on the stock. And any positive management commentary, I think, will give boost to a lot of investors who are there and stuck with Laurus for a moment.
What do you make of the news in IGL, Mayuresh? How detrimental that could be?
So on one hand, Nikunj, I think the expectation is to take the part of natural gas portfolio in the overall economy from 6 to 15%. So I think more and more geographical areas will obviously get added on. On the other hand, what has probably happened in Delhi, I think we've been hearing about this time and again, but if this gets implemented in the coming year, the expectations for IGL, because they derive around 15% in terms of CNG sales, specifically from Noida and the NCR region. And it's impossible for one to presume that the entire 15% will go up. Even if the entire 15% probably goes off, the kind of hit that can come through in terms of both the EPS and in terms of cash flows onto their balance sheet can be anywhere to the tune of 300 to 400 crores. That is what the back of the envelope calculations is saying. The kind of correction that the stock has probably witnessed is far more in terms of the knee-jerk reaction that the market is probably meeting out to the stock. So even if one assumes that entire 15% to go off, which I don't believe and think so, and the new geographical areas not ramping up to a certain extent, yes, numbers will come off, and probably the numbers which have come off, the stock correction has probably indicated that. But with this news, obviously a sentimental impact onto the stock.
Okay, those are a couple of ideas coming in there on IGL, which, by the way, of course, is really taking it, sharply on the chin right now. And I think it's the biggest fall that it has seen since COVID times. I think it's fallen about 15% in the last just 2 odd trading sessions. Kunal, a big breakdown on the stock, and I'm guessing you would see a follow-through selling as well, right?
Well, the follow-through selling's already come. The stock, I think day before yesterday also we were discussing, and I mentioned specifically that these are the kind of stocks which we typically avoid to trade because, just 3 days back, the stock was at 490 levels, which was a swing high for IGL. And now the stock is almost on the verge of breaking below the 400 levels, which could again be a major swing low for the stock, almost a 8 or 9 month swing low for IGL. So these are the kind of stocks which we typically avoid. Tomorrow you may see a bounce for the stock, and it may come back towards 410, 415 mark before it gets into another round of selling pressure. So completely avoid.
Okay. And in case you're wondering why this steep fall in IGL, the aggregator policy is now mandating EVs approved by the Delhi Chief Minister himself and a faster adoption of EVs in the National Capital Region, where IGL is a dominant player. So you are seeing a big fall. By the way, just to break it down for our viewers, what it really implies is it entails about 5% EVs in the fleet of the likes of an Uber, Ola in about 6 months' time, 50% EVs in 3 years, and 100% in the next 5 years. So that's really going to weigh in and eat up into the business of IGL for sure. And a complete electric conversion of all commercial vehicle categories by calendar year 2030. Fleet operators will need to get a new license within a span of next 90 days itself. So yes, entailing a faster adoption of EVs in Delhi after CNG market and IGL as well. So that's why the stock is facing the heat the way it is. In the meantime, while nothing really is happening within the large caps, I can only, recount pressure points. That's, of course, the likes of ITC, Unilever. These are the numbers which are, these are the stocks which are weighing heavy on the markets. Metals as well, JSW, Hindalco, Tata Steel, some of the pharma names like a Divi's, Cipla as well, under pressure as we speak right now. In the meantime, JSW Steel numbers as well, since we were on the subject of some of the metal names. The numbers will just come up for you on your screens. The PAR at 2760. a little bit higher than the ET Now estimates, largely in line. We were penciling in a figure of roughly around 2,500 odd crore rupees for JSW Steel. We will just shortly get in Ashesha as well and try and stack up as to how they match up with what the ET Now poll was actually penciling in for JSW Steel, because we were anticipating the PAT, like I said, to come in around 2497 odd crore rupees. Realizations, we're expecting a fall of about 2 to 4% on a sequential basis, owing to lower steel prices in the second quarter. Remember, the average steel prices fell about 2 to 5% sequentially and about 5 to 12% on a year-on-year basis. So that's going to get reflected in JSW Steel's performance as well. Raw material costs also declined in the second quarter, so that's another factor to look out for. What they have to say about RM pricing outlook, the commentary on FY24 production, the sales guidance, all of that is something that we're going to be looking out for. But in terms of revenue, we are expecting a flattish performance. In fact, a mild dip on a sequential basis. We're expecting the revenues to come in at 42,133 crore rupees. 44,000 is what they've actually delivered. So that's a little bit higher than what we were penciling in. And yeah, in terms of margins, the 17% figure is what we're working with. You're seeing a bit of a recovery play out for JSW Steel.
These are, not bad numbers, Aisha. I mean, the new capacity addition and all the other factors have kicked in. Now, the point is that the quarter gone by was not a very strong quarter because of high coke prices, China demand not filtering in, but being the converter they are in, I mean, we are looking at huge, it's not a huge uptick in terms of profitability, but what really matters is that directionally, I mean, you're staring at a company which almost now has a 10,000 crore consolidated PAT. And if large part of your capex is over, then this could be a very different company in terms of generating cash flows and where things could move in terms of where the business is headed. So JSW Steel, if you frankly ask me, we don't realize it, and it could be one of the rare steel companies which has given you returns like an FMCG company. Let's look at it. 10-year return, 12-year return, 15-year return, whatever our producer can punch in fast. You'll actually see a big wave of compounding which actually has happened in JSW Steel. Let's look at it. PAT, there you go. 10 times. Thank you, sir. Mayuresh Joshi, who would have thought a steel company in last 10 years would have given you a 9x return?
No, I think domestic steel companies are still holding out. I think I completely agree in terms of your thesis. The expectations that are now coming up is that a large part of the capex is largely behind us. I think some part of the capex is going to get carried forward in this financial year and the first half of the next, but the bulk of that capex is probably behind us. And with the expansions that are probably happening at its respective plants and the backward integration operations thereof as well, you're probably going to see a better EBITDA number on an absolute basis and on an EBITDA per ton that JSW Steel is going to produce. Again, I think it's largely a cyclical industry. We all know that, but a large element in terms of the infrastructure spending that is still expected to come through from the government side. I think that will reflect in better numbers for at least these domestic steel companies, where a lot of consumption might happen on local sources. And as prices recover on the LME, with China demand expected to come back in the next financial year, I think even the top line growth in terms of realizations for a lot of these ferrous players will continue to gain traction in the next year and a half as well. So yeah, I think domestic steel companies like JSW Steel can continue.
Right. Mayuresh, any stock or sector ideas that you're working with right now? Kunal was pointing out that from last month to now, we've at best just moved around in 100, 150 odd point band on the index, and even the small and mid cap indexes have not done a whole lot on a month to date basis, that is, or rather on a 1 month basis. Just wanted to understand, what are your biases both within the large caps as well as small and mid caps?
So cement and road construction companies, Aisha, I think they remain probably on our buy watch list. Within the large names, again, Ultratech is something that we continue to prefer at Marketsmith India. Large player, national presence, expectations in terms of carrying out the leverage capacities quite well. And again, I think not too much of debt onto its balance sheet as well. Within the same universe, in the mid-cap universe, Dalmia Bharat remains on a global focus list. Decent set of numbers that the company posted, an EBITDA of 955. And a small company in the Northeast, Star Cement, is also something that we like. They're expanding both their grinding and clinker capacity in the Northeast. zero debt company at the end of the day, and expectations in terms of reasonable amount of volume and value growth should suffice strong earnings growth for players within the cement space. Road construction company is also very interestingly placed. I think the acceleration in a lot of infrastructure projects, and specifically road projects to be particular, is expected to continue in the next few years. A few of the lesser leverage companies like a KNR Construction, PNC Infratech, stay on our buy watch list at MarketsBet India on two counts. One, I think the kind of equity inflows into their existing EPC and HAM book is very, very minimal, and their existing cash flow should suffice for that. On top of that, minimal or no leverage or negligible leverage onto their books, which means as improvement happens in terms of execution and with better IRRs coming through for most projects that they are executing, I think they will remain in a key focal area in the next few quarters as far as earnings growth is concerned. So I think a few of these pockets look very, very interesting.
Right. Okay, Mayuresh, great to have you on the show. Thanks as always for taking the time out and joining in. Let's get in some, closing strategies as well from our experts, or for that matter,